Welcome back. The Nifty is holding above 19,500. It's just a very mild downtake. In fact, in the last 30 minutes, we've seen some buying emerge in the Nifty and the sensex. The midcap index has managed to get back into the green. Rajesh Kothari, Managing Director at AlfAccurate Advisors, is with us on the show. Rajesh, afternoon, and thanks so much for joining in. Your portfolio predominantly has a lot of small caps. I think majority of your holding is in small caps. Are you a bit worried about this relentless one-way turbocharged rally that we've seen? Are we getting into uncomfortable zones now?
Well, I think, we have two main our portfolios, and I think you are talking about, so what is our, of course, multi-cap portfolio? In AAA India Opportunity PMS, which is a multi-cap, we have a 58% large cap, and the balance is mid-cap and small cap. I think you are referring to probably AAA Budding Beast, which is a predominantly mid and small cap offering. The good part of this product is a little bit different product. Actually, if you look at the portfolio, we do not buy any small company. So let me tell you how we look at the companies. We look at the companies based by the profit size rather than market cap. So typically the small companies, the micro companies, which are making 10, 12, 15, 20, 30, 40 crores kind of a profit, we actually avoid them in our portfolio. So predominantly, all our portfolio company, be it a mid cap or be it a small cap, they all are market leaders. Most of them are oligopolies. They are monopolies. Most of them would have zero debt on the balance sheet, or they would have low leverage, debt equity less than 1 time. And most of would have 20% plus, return on business capital employed. That's kind of a company's characteristics, what we buy. Now, coming to your question, undoubtedly, the micro cap part of the market has actually moved up significantly. The mid cap and small cap has not yet moved up that fast compared to the micro cap, where there is a lot of momentum investing which is happening by particularly, if I may use the word, retail investors, or maybe it's a speculative interest. And clearly one needs to be careful before one invests into such kind of companies where probably there is a lack of fundamentals, lack of strength of balance sheet, a lack of right management and right governance. But otherwise, we are not too much worried right now in terms of the overall market valuations. Valuations are still comfortable. We are trading at about 10 years average valuations. It is not significant premium compared to what it used to be in last 10 years. And also, one important thing which I would like to highlight is the return on capital employed on the overall small cap companies, not micro cap. I'm talking about small companies, good companies, but small cap. They've actually improved a lot in last 10 years. And that's why there is a lot of, interest in this kind of companies, be it a mid cap or small cap, for the right fundamental reasons. So don't worry too much about timing the market. If one has a 3 to 4 to 5 years view, surely this will continue to pay off in the medium to long term.
Rajesh, hi, good afternoon. Good to have you on the show. So you tell us, you own stocks pretty much across the spectrum. Now, there are certain spaces like, mid-size or small-size defense companies where stocks have literally gone through the roof. Even this electronics manufacturing space, absolutely hyperactive pockets of the market. So within mid-caps and small caps, have you been sort of part booking profits in any segment of your portfolio? Is there any area where you would advise to lighten up a little bit? And conversely, if you would do that, then where would you move the money? Where do you still see a decent value, at least, in mid-caps?
I think, Shubhi, you have hit the nail. What is most important is just not focus on what to buy, but equally focus on when to sell. And the discipline exit strategy is something very, very important for us to keep generating that alpha for our investors. If you look at last 2.5, 3 years, we have generated decent alpha compared to benchmark indices. So what we look at is that when we look at any company in terms of the earnings growth prospect, like if, for example, if you remember 2 years back, from last 4 years almost, we have been very bullish on specialty chemical space. But about 3 months back, most of the specialty chemical stocks, we have exited our portfolio. Correct? So that's everyday review. How do you see the business growth? How do you see the valuations? And keep changing your portfolio depending upon growth, underlying ROC, and underlying valuation. So one space where we have exited about 3 months back, not last day exit, I'm saying about probably January to March quarter, where we exited most of the specialty chemicals companies. And we moved that more little bit into consumer, we moved more into auto ancillaries. And these are the two themes, if you ask me, in terms of mid and small cap space, even today at these valuations where we are seeing a lot of comfort. The auto ancillary pack, we expect it to do extremely well because of the EV thing, which is a new thing which is coming in. The content per vehicle is going to be significantly higher than what we are seeing in last 3 years. And that will lead to significantly better growth opportunity for many auto ancillary names. So for example, we added one of the name, last month, and this company which is supplying, say for example, 30 rupees component per vehicle. Now the opportunity is going to be 300 rupees per vehicle. So it's going to be almost like 10 times. That's the size of opportunity I'm talking about. And as the more aesthetics, more electrification of the vehicles, more sensors, more safety features, and so on and so forth, that leads to a completely new dimension to the growth. And therefore, I think this space will continue to do well. So that's one theme, one sector, if you ask me, where we are adding to our weightage.
All right. Hi, Rajesh. Just coming back to you in a bit. By the way, guys, just pull up the intraday chart of the Nifty. It's up close to 100 points from the low point of the day. And there's a big move that we're seeing. Tata Consumer Assets was doing well on hopes that they close out that Haldiram deal. So that's one should come up for you. Bajaj Finserv has done pretty well. And I think HUL and ITC, both of them larger weightages in there. Both of them, in fact, have moved up. And now we're in the green. So this buy on dips just continues. Rajesh, one of the big winners for you all is this Safari Industries. It has a decent amount of one of your portfolios. My question to you is, one of the reasons that they've done well is because of what they have done, but also the largest player in there, that's VIP Industries, hasn't done well, and they have been really lagging. Now, the street expects some kind of corporate event out there. What if VIP comes back, in a big way? Do you think then, in fact, the Safari industry, the way they're growing, you'll see some bit of a slowdown, and that could be a risk? How do you view the sector on the whole?
Well, Nigel, I think what is important is when we look at any sector, typically we identify the sector where there are only few organized players. Like, for example, luggage industry. There are only 3 organized players. You have a Samsonite, you have a VIP, and you have a Safari. Of course, Samsonite being MNC is unlisted. So basically 3 players market. An unorganized sector is huge. It's a huge unorganized sector. So the size of opportunity is big, be it for number 1 player or be it for number 2 player. And within that, if you look at the China, the imports were a major problem in last 3 years. And even today, if you look at it from the duties perspective and unattractiveness of the China versus the domestic market, definitely it favors the organized players more compared to the unorganized players. Another important thing which is happening within luggage is the preference for hard, compared to the soft luggage. And if you want to buy the hard luggage, then it requires a significant amount of capital expenditure, which is not possible for any mom and pop store to do it, because 70 crore line you need to put a new machining line. Now that's absolutely not possible for small companies or small players, unorganized players. So that again benefits the organized players. Within organized players, of course, name what we own have done extremely well in terms of the product launches, in terms of the product offerings, in terms of extending the product offering from the mass segment to coming to the kind of, I would say, premium segment, not yet into the luxury segment. And that's basically from where the growth is coming for Safari. Please put a disclaimer because we own this thing for our portfolio clients. And I think the story continues to remain very solid. If this kind of a growth, this kind of a product offering, the innovation, one of the probably the first one to launch so many new styles, so many new SKUs within the luggage. So in fact, as I say in Hindi, the bag bolta hai, So when you go to airport, you don't speak. Your luggage also speaks about you, correct? And that's where basically Safari is now positioning to the millennials, to the youth. And I think that's what is customers liking about it, and that's why rightly they are gaining the market share. We continue to remain positive on this team. I think they are doing a brilliant job, be it market share, be it revenue, be it margins, be it capital allocation, be it the new product launches, be it on-road intelligence in terms of the dealers and distribution network. So we continue to own this name and we remain positive.
A big scope of penetration, big unorganized market as well. So these 3 large players will continue to get bigger. Thanks so much for joining in, Rajesh. And as you mentioned a couple of times, your portfolio has been outperforming what the index has been doing. So kudos to you and good for your investors as well. But as that